I think there is a very big possibility that we would be able to go out and cross the $1 trillion mark in the next 5 years.
Can it grow to 19 trillion? Is it realistic?
I mean, there has been a good uptick in a lot of serious interest from the industry. If all these asset managers are interested and there is a value proposition, I think the number will scale even without stablecoins.
Do you expect another asset class or another type of RWA to sort of stand second to stablecoins?
Private credit would be the second biggest market. A lot of private credit funds actually are already coming on blockchain. And a third one, very briefly, would be real estate. But slowly and steadily, I think these are three assets which would become like the major assets to be tokenized in the upcoming years.
Would we then see property costs potentially come down, real estate costs potentially come down?
In general, what is happening is...
Hello, and welcome to another interview on ccn.com. I'm here with Aishwary Gupta. He's the head of payments and RWAs at Polygon Labs. Thank you for joining me, Aishwary.
Thanks, Heidi, for having me here.
How are you doing today?
I'm good. How about you?
Pretty good, pretty busy. I can imagine things are pretty busy at Polygon at the moment.
Yeah, absolutely. It's too much going on all around.
Is it because it's just like everything's going pro crypto, pro stable coins, pro everything at the moment?
Yeah, absolutely. I think there has been a good uptick in a lot of serious interest from the industry. Earlier, there was much more like, okay, from blockchain's perspective, we used to be like, okay, do you want to do something on the blockchain side? While now the interest has been like, okay, we want to do something on the blockchain side. How can you help? So I think there has been a very big difference in the way that like these enterprises and everyone has approached, because like mostly the legal lay of the land is kind of improvising on how we can tackle the asset category in general.
Right, and a lot of this improvisation is sort of based around this idea that RWA tokenization is the next revolution in blockchain or Web3 or in equity markets and bonds or stocks, real estate, payments. What is RWA tokenization solving? And I guess the other question is, what problems might it also introduce?
Absolutely. I think like if you look at multiple asset categories, in general, what is happening is like a lot of that trapped liquidity is getting unlocked. So like let me walk you through various asset types, which essentially helps you understand like in different assets. So for example, if you talk about real estate has been as illiquid as possible before tokenization. But slowly and steadily, what is happening is with tokenization of real estate, the people who can actually go out and acquire that real estate in a tokenized format, maybe as a fraction of it and not the entire one, that is actually increasing the total AUM of the investment that is coming in, because now more and more people can invest. Similarly, like I think this is opening up for the global world, which enables us like not to just in that own country or like neighborhood to raise funds, but enables like globally the liquidity flow. So like it just opens up the floodgates for a lot more international investors to actually come in. So that is one. If you look at like private credit has been inaccessible because of multiple reasons. One, it is the ticket size is very high. So a minimum of $100K to $1 million is something you have to invest in private credit to be able to go out and access it. But like through blockchains, I think that the same thing is getting reduced. So the total amount that today like you can put in is like, let's say $50,000 or like $5,000. So that essentially is reducing that AUM. And it is also building efficiency because you can get in and out faster because there's a market to it, which essentially never existed. So you always had to go to the broker who was essentially either bringing you the asset or to the asset manager to be able to go out and take that asset and redeem it. So that is getting more and more like competitive. That is getting more operational. And then also like all these other private credit funds, which effectively you could actually not liquidate because they're quarterly redeemed or like there is too much hassle to go out and get that done. I think there are secondary liquidators that are coming in, bringing that. You can leverage these positions. So I think overall, that is what is happening is overall, all these things are adding a lot more value overall to the way, like I think the overall crypto market is enabling this tokenization. Like these stocks, I think enabling it 24/7 across the world is one thing that also is giving more liquidity, more time for people to trade based on what time they want. But this all these things also, like you said, I think there are some limitations also, or there are some can of worms that it is also opening up. Like for tokenized stock, like we talk about tokenized stock, we want to go out and use them on a daily basis. The liquidity for these assets is very low. So if there is a big order, the price fluctuation, or you will have a massive slippage. You want to buy like a large order, and the liquidity is not there, you're wrecked. So those kinds of checks and board. The other is like the way these tokenized stocks are getting issued. So often, like one of the ways in which this is getting issued is it's just getting the underlying share. But what happens to the dividend? What happens to your voting right? All those are like at large yet. So I think that is one risk. The other is like there are a lot of people who are counterfeiting also, like they are kind of issuing fake assets and just trying to pose in the market, oh, this is a BlackRock fund, you can subscribe it at a lower AUM, but in reality this is not like even a BlackRock fund. Like this is some scams which are actually going on. And I think the last one is from a regulatory perspective, like there's still a lot of gray area which needs to be kind of built onto to get clarity on from the government side before all these things can actually work properly on chain.
Right. So basically, it's the same thing that I sort of been reading everywhere. Is yeah, unlocks a lot of capital markets. It's going to give a lot of people access to these markets. And yeah, my one of my concerns is that this sort of 24-hour access, international access, could create a time bomb for a lot of companies or low liquidity companies. But that still doesn't stop sort of people like companies like Ripple saying it could potentially, the RWA market could reach 19 trillion by 2033, which is wildly ambitious when you think that stablecoins they only represent maybe 250 billion of the crypto market cap, and that's like the most popular, biggest, most common use of an RWA, tokenized RWA at the moment. Can it grow to 19 trillion? Is it realistic?
I mean, from our perspective, the way I'm looking at it, I think there is a very big possibility that we would be able to go out and cross the $1 trillion mark in the next 5 years. Realistically, why? Because like we are talking to some asset managers, even ourselves, which means that other blockchains are talking to other asset managers as well, where essentially the AUM is in trillions of dollars. So if all these asset managers are interested and there is a value proposition, I think the number will scale. There would be like much more tokenization that would happen because there is a serious interest that we are seeing from the government side, from these bigger asset managers side who want to kind of tap into the tokenization world. So overall, I think there is a very big possibility of this actually going out and crossing $1 trillion. Even without stable coins. Stable coins on its own would probably go out and expand massively because like a lot of companies that we are talking today too, they are all looking towards stable coins, how stable coins can actually go out and enable them to move money rather than just using the existing rails that they've always historically had.
Right. Yeah, because payment coins going to go crazy now that the US regulations have said, okay, we can go nuts with it. And they'll probably continue to be the most popular or common use of tokenized RWAs for a while. Do you expect another asset class or another type of RWA to sort of stand second to stablecoins in terms of usage or utility or popularity?
I think the second thing that would come on is private credit. Like private credit would be the second biggest market in the stablecoin world after the stablecoin world because I think private credit is very much there to be unlocked. A lot of private credit funds actually are already coming on blockchain and they are seeing good amount of traction, not because like effectively in the traditional world they were not effective. It's basically they are able to do more with that. Like for example, if you look at the ACRED use case on Polygon, where effectively the naked Apollo credit fund gives you somewhere around 8 to 9%, but you can put it on Polygon in the Polygon DeFi platform called Morpho. And on Morpho, you can use it as a collateral, then you can borrow stable coins against it, and then again, like create a loop on it. And like on the loop, we are almost earning somewhere between 13 to 15%. So the same asset, with Loop is actually going out and giving a much higher return. And I think this is not just one-off case. There are multiple others that we're talking to right now, which are ready to come on live, which effectively will enable a lot of these efficiencies into the market, and it will also lower the barrier, or which is like the AUM that people used to put in that market, which means more people will come in. So a lot of those strategies would be available publicly for people to be able to go out and take in advantage of, and hence private credit would be like, I think, the second one, which would become like the biggest one, and a third one very briefly would be real estate. So real estate is also almost ripe for that market, but like it will still take a little bit more time because of the liquidity constraints. Like not all real estate markets are liquid, and that is because of a reason, which is like they are heavily like regulated, and they're also like bigger in air size. So but slowly and steadily, I think these are three assets which would become like the major assets to be tokenized in the upcoming years.
Right, it makes sense. I think BlackRock's sort of leading in that regard because they've got the build all fund. They've done I mean, they're killing it in terms of Bitcoin and Ethereum ETFs. Their iShares trust is the best one by far. Billions and billions and billions is poured into that. What would be their next play, or I guess what would be the next big institutional play for RWAs, for the big institutions? I mean, like you said, real estate, custody, but surely something is coming up soon.
Yeah, I think most of these asset managers that I am at least talking to, they are all interested in how we can get the assets into DeFi to create more efficiencies. I think that is going to be like a massive kind of thing that would come later on, because today, like even if you buy, like there are a certain category of people always who have these privileges, but today if you're buying a stock, can you go out and use it as a collateral to borrow against it to do whatever you want? For a general person, answer is always no. Like you cannot do it, right? But like this is selectively available for everyone. And like a lot of people want to go out and leverage these things more and more effectively. And the reason why all these things will actually go out is also because the efficiency is really good. Like you go out and take a home loan, let's say in India, at like 9-10%. However, I can, if I have a tokenized version of that asset and I can put it and borrow collateral against it as a much cheaper rate, I would want to do that. And like historically, like I've done that for my own house when I had like Ethereum, which I put as a collateral and borrowed stable coin to like just buy my house without actually diluting it. So this is something which is like, it's happening. Like people are doing it because I think when I took it, it was a bear market, and the interest rate that I was paying was 2.5%. And if I look at the INR dollar charts, that was basically set off by the depreciation between INR dollar. So I had literally a zero interest loan for my home loan in India, which is absolutely impossible to get in
Yeah,
like a
that's
traditional.
unheard of. That never happens in reality. So this opens up a big opportunity for people then, I guess, looking to get on the property market, which obviously the institutions would be most keen on doing. I guess that comes in quite nicely with private credit because people will be able to get their mortgages collateralized with their crypto, or where are things going? It all sounds a bit confusing.
I mean, yes, like even like if you look at 2008, like we always thought that 2008 the industry failed overall. Like my personal opinion is the industry did not fail. People became greedy, and there was no one who could tell them that you're getting greedy and you should stop getting greedy, right? Like I think the mortgage backed MBS loans was not the problem. Initially, they were like high quality assets. Everyone was happy, but then the bankers became you can say greedy. They were like, oh, this is a very good thing. We should kind of go out and mix and match everything because the highest quality asset is gone. But can you do the same thing using a blockchain? The answer is no, because the moment you start mixing itsy bitsy assets on top of it, and like this can be tracked on the blockchain about the quality of the asset based on like the repayments that are coming in, it would create a secondary market, which essentially is not available. Like another example is if you look at a lot of Western capital that wants to invest in Asia, like the interest, the return that most of these capital is getting is 7 to 8% or 9%. but like because the dollar and the native currencies of these countries are like set up in a way that 4 to 5% is depreciated by the currency fluctuations. So effectively nobody is getting like more than 5%. But if I can create a secondary market which gives a real time update on the asset underlying, and then I create a market that effectively will unlock a lot of possibility, because let's say the same MBS of 2008, I have 10 assets or 10 mortgages in a MBS, and it is connected to the bank, and every month it is just updating whether the EMI of that particular MBS has been paid or not. If it is not paid, let's say I'm a very risk averse person and it's $1,000 MBS, I would want to sell it at $960 or $980, whatever, which effectively adds on to the total like returns that you would have made. So earlier it was just like 4 to 5%, but now with more and more people kind of going out and taking part into it, they would want there is much more to be made, and hence now the capital would flow in as compared to how it has historically not have been able to do.
So we're going to have easier flows, less friction on capital markets, more access to property. Maybe this would be a bit of an ambitious question, but would we then see property costs potentially come down, real estate costs potentially come down?
I mean, yeah, it would be basically a market demand based market. Like today, what happens is, because like you can price the property at whatever valuation you want, but the sale is first of all not actually accounted for realistically, because different rates, different brokers, different people going out and doing these things. But effectively, you would be able to assess the demand very easily as compared to like when you have these tokenized versions on chain, and how many people are actually bidding for it, how many people are actually willing to spend that much money. So that would kind of bring a better pricing. I would not say it would bring the prices down, but it would bring a better pricing. There would be areas where they are too highly priced, it might bring the prices down, but there might be areas where the general prices might be showing lower, but they are actually way higher, so the prices would go up. So what it will enable is more fair discovery, rather than like saying it would enable lower or higher prices. So much more fair discovery there.
Could you explain to our readers and listeners what fair discovery means to you and how that applies to them?
Yeah, absolutely. So I think mostly what happens is like you depend on a circle rate for a particular area to go out and say, okay, this is something which has been set up by the government. Often call it circle rates, area codes, area rates, and all these things. And effectively, what happens is the rates are defined by the government. So this is not a free flow market. The government will say, okay, this area is worth this much, and then like there could be a plus 10%, 15% price based on, like, let's say it's a very good property, it has a very good sea view, it has something which is like adding value to it. But that is not free or fair value. Fair value is something what I am ready to give it to give for that particular property. Now, based on like the demand of that region, that price could be lower than the circle rate, or that price could be higher than the circle rate. This is something which is not discovered in today's mechanics, because that is highly skewed by like what government feels that the circle rates would be. A fair market would be something where you are not determining the prices of a place based on the government rates, but you are determining the rates based on how the demand is coming in. So let's say a property is listed at 1 million, and I feel, okay, this property would not go for more than 800K. So that property would continue to be listed there and nobody would buy it, which means the fair market and people will bid for it. Like if you enable a bidding, you will see the highest like the bid range would be somewhere between 750 to 850. So okay, this is the range of a fair price rather than what has been already described. So it creates like much more fairness when you're actually going out and buying and selling, and it also reduces a lot of like the secondary or cash component to it. Because if my property, including your cash and the bank component, is $1 million, I would want my token to be valued at $1 million. I would not say, okay, you give the token at 800K and give me the cash at 200K. So that also
Right.
creates much better market mechanic for that.
Is this something that would apply more broadly to RWAs then? Would fair market mechanics sort of happen in RWA markets?
Yeah, absolutely. I think a lot of like private credit, which is considered as a very high value credit, might go down because people are like starting to discover that, okay, guys, this is something is not working out. And like the real numbers are different from there. It's just that because like blockchain enables better auditability. Like I'm able to go out and check like the way you do the audits today, it's always sample based. So you are taking a sample of the entire financial structure, the entire financial product, and then you are saying, okay, we checked five things out of this 100, and these five things were correct. Hence, we are assuming that the entire 100 things are correct. But on the blockchain, you cannot do that. On the blockchain, you will be always like, okay, we have checked these 100 things because that is what blockchain has enabled for us. And now I'm giving you a report based on all the data records that are checked. So this actually, like, if there are people who are like getting their rating just because they know someone at some rating agency versus actually getting a rating because the asset actually exists on the asset chain, I think that would be a big transformation. But I don't think it's happening now. It's gonna take like at least 4 to 5 years minimum to be able to go out and enable those kinds of tools to be able to get these valuations very clearly done.
Right, but it seems like the ball is rolling in the US at least because they've got the Genius Act and Wyoming's got its state-backed stable coin, the Frontier stable token going on. So presumably we should expect sort of these developments to happen in the US over the next year or so, right?
Absolutely.
What should we be expecting from the US in 2026 on the RWA front?
I think like a lot of this will start moving, like a lot of this asset tokenization, which historically has happened on private chains, we don't know of. So I think what we know from a tokenization perspective is what is there in the public domain. And those public domains are also something that are getting updated. Like there are a lot of RWA tokenization that would have happened, but we don't know of them because nobody reported about it. So I think a bigger framework, which essentially will enable better reporting, more of these assets coming into the public blockchain, which were already tokenized. Because like I think there are a couple of partners that we are talking to who essentially want to have a blockchain based registry, so for all the asset managers or all the assets that they're trying to manage. So that means that what this would enable is all these assets to be coming on chain and all their registry to be happening on chain, creating a lot more value, and then getting this all embedded into the banking system as well. Like, so imagine all these like assets that, let's say there are 10 different banks, they want to tokenize the assets, they have their own chain or they launch their own chain or they deploy it on public chains. Now once that is done, you like the role of DTCC today is to kind of go out and merge all these inter company or inter bank settlements and provide the settlements among each other. So all that thing actually comes on the blockchain itself once these different asset managers come on blockchain. And you see all that settlement with DTCC does tomorrow, DTCC doing it on a particular blockchain, let's say, or their own blockchain or whatever. Like, so that is something where what like I'm seeing, like a lot of those things would start moving on chain. There'll be a lot more addition to this entire credit cycle as well.
Sounds incredible, to be honest. It's probably going to be I think we'll see hopefully more conversation around tokenization than things like altcoins and meme coins next year then. How are these developments affecting Polygon, and where is RWA tokenization industry headed over this next decade?
Yeah, I think the good thing is like with Polygon, we already anticipated this is going to happen. So we have like a good head start. Like if you look at the asset issuance on Polygon, we are second to only Ethereum. So the number of assets issued on Polygon is like the second highest when it comes to their. When you talk about the variety of assets, be it bonds, be it tokenized shares, be it like tokenized like financial assets, money market funds, private credit, all of that has already happened on Polygon. So we've already set the examples. All these assets already exist on Polygon, and like more and more of these things are coming in. We have just like we started focusing entirely towards payments and RWA overall, which effectively, and the team is also set in that way. So we have a very big, like almost 12 people team who's just focusing on payments and RWA. So I think we have already adjusted to that because we knew this is coming. We already made the necessary hires. We already brought the right people in, and we already are in like a lot of right conversations. So that's where I would say personally we are a little bit ahead of the curve, how this is coming in, and we're trying to shape that up. overall for Polygon.
Amazing, congratulations. So then, finally, I guess to wrap things up, because everyone talks about in crypto, it would be the Bitcoin ETF that would be the mainstream push, or Web3 gaming will be the one to bring the most users on to crypto. And there's no sort of talk about what the breakout for RWA tokenization is, because it goes in so many different directions. And you've spoken about private credit and property, but is there something that the everyday user is really going to tap into anytime soon?
I think they're already doing it. So from a perspective of payments, if you look at Polygon, like we have the highest retail numbers in the USDC side. So the number, like we almost constitute 23% of the total USDC users overall for USDC. We're the third biggest chain for USDT. We have started like non-USD stable coins. I think Brazil, we are one of the top ones. So one of the biggest use cases payments that is coming in. And from that perspective, like apart from payments, the other thing is earn. A lot of people want to save in dollars. So I think the 21 cycle was people wanted to escape from their currencies which were depreciating to dollar. Now what they want is like, okay, we have already escaped, we know how we have escaped, so we are in dollars, but now we want returns on our dollar. So they want to go out and invest, they want to go out and have a crypto card which gives them cashbacks, they want to have investments in money market funds, in like AAA CLO bonds and all these other financial products, which effectively is the natural growth of like a user. And that's what is happening on Polygon. So all like most of our user base is like loves doing payments because it's ultra cheap. The chain has been standing for 7 years. Everything works like really well. It's fast enough for everyone to kind of go out and do transactions. So it's a natural choice for people. And what we are just doing is just giving them more and more opportunities. So once they enter the economy of Polygon, they stay in the economy of Polygon because there is no reason to leave because they have everything on Polygon.
I think that's the perfect place to leave it. Aishwari, thank you so much for your time.
Absolutely. Thank you so much for hosting me.